Thanks everybody for joining us this morning. Michael and Fly, thanks for having me on here. I got a tough act to follow after the last presentation. I don't have nearly as many pretty charts or graphs to go through here, but I'm excited to talk to you this morning about Dream America, the business that we've put together over the past few years, and why we think that it's well positioned to outperform investing in single-family residential in the current environment. So the backdrop on me and the fund. I joined. I spent 25 years on Wall Street, working on and running trading desks at Salomon Brothers, Bank of America, and BNP Paribas. When you're in the markets business, obviously your P&L can change very quickly, and you think a lot about downside and how to mitigate that risk. And so in coming into the real estate space, where I've been investing since 2000, but was really doing that on the side while I was working in my day job on Wall Street, I brought that same mentality, which is not just what are interesting areas to invest in, how can we make money for ourselves and investors, but also how can you mitigate downside risk. And that's what really brought me to the residential lease-to-own space. It's an area. It's an area certainly that we didn't invent. It's been around for a long time, but it's one where there's not a lot of competition. There's not a lot of people doing it. And as I dug into it, I realized that we had the ability to differentiate our returns and mitigate our risk through our operation. That takes investors on a monthly basis, and we pay distributions quarterly of our rents and profits. We're very much an operating business, and it is through that operation, as opposed to just the real estate itself, that we're able to differentiate our returns and our outcomes for investors. So we wanted to have a product which would have high current income, which we do, that we could distribute quarterly, have appreciation potential. We certainly didn't foresee the inflationary environment that we're in now, but even pre that, median price homes in the markets that we operate in, which is in major metro areas in Florida, Georgia, and Tennessee, those home prices have been appreciating steadily since 2012 for a lot of the reasons that we were just hearing about in terms of demographic trends, people moving there. So all of the things that happened during the pandemic, they were happening before. They just accelerated maybe during that, during that period. And then we also wanted to be able to offer our investors annual liquidity, which is unusual for a real estate fund. But you'll see as we get into our strategy, we turn our portfolio over on a regular basis by selling our homes to our tenants. And so there actually is the possibility to give investors liquidity in a much shorter time frame than they might have in a traditional real estate investment. So we just put here as a reference point. I'm sure you guys all know these numbers. Where, despite the move up in rates, where are yields now? You've got 2-year treasuries look relatively decent right now, not versus inflation, but on a nominal basis. High yield, still not 8. I've been around long enough to remember high yield numbers well into the double digits, into the teens. Anyone who's invested in high yield this year has obviously had a significant loss. The cat, so you could just go out on your own and buy a single family home and rent it out. But after you take out your property tax, insurance, property management, etc., you're going to find that you're probably getting a yield that at this point is less than your financing costs. So that can be a tough way to make money. And then we come over to Dream America, where we're generating a 10% plus yield, and our duration has been just over a year. We'll get into that. Next slide here. So our program that we launched in 2018 is offering rental homes to aspiring homeowners. So what we're looking for are people who say, I would like to buy a home. They've already made that decision, but for one reason or another, they don't qualify for a mortgage today. And the type of mortgage that our clients are going for are FHA or VA mortgages. FHA mortgages are open to everyone. VA is obviously for vets. These are great programs that are sponsored by the US government and have made homeownership available for millions of Americans who would frankly not be homeowners if not for those programs. That being said, there's also a large pool that we estimate at 35 million renters nationwide that are kind of hovering around the hoop of FHA or VA, meaning they have one or two things that they need to do before they'd be able to get that mortgage, and they may figure that out on their own or they may not. And that's really the group that we're looking for at Dream America. They've got income, they've got cash, but they need a helping hand to get over. And an important component of our program, this is what I mentioned before in terms of differentiation through our operations, is not just that we're putting people into a home and saying, yeah, you could buy it if you want to. We're actually giving them a game plan. We're not, but we know what the guidelines are for these mortgages. We've helped many people get them. And we know that if you follow those steps, you'll be ready for a lender, and we can put you in front of one. In fact, we've got many that we work with. So we've had a high success rate with that in our program. For our client, once we've approved them, they can go out and pick any home that's available for sale in our areas of operation. Atlanta's a big market for us. Dallas, Tampa, these are all markets where, despite the move up in home prices, homes are still relatively affordable, certainly more affordable than the Northeast or what we may see on the West Coast of California. So they go out, they pick any home that's available for sale within the budget we've given them. We buy that home and rent it back to them for a year with an option to buy at any time. So why does this strategy, from an investor standpoint, okay, we're helping people become homeowners. That's a good social mission, but how does this help investors? How does this strategy help? We're collecting a premium rent each month. So the cap rate that we've used since inception was 8.75. We moved that up to 9.25 this year. That is well above what a rental might be. And what we're gearing ourselves off of is not where could you rent this house, down the street. We're looking at what is your fully loaded cost of a mortgage when you buy. And because our goal is ultimately to get our clients to buy, we don't want anyone to ever be in a situation where they look at that fully loaded mortgage payment and go, wow, that's more than my rent. I'll just continue renting. So as rates go up, particularly as mortgage rates go up, we need to continue to move up our cap rate to maintain that premium so that we're always a few $100s more. And that's part of the incentive for people to buy. We collect a 1% upfront fee. That's 1% of the home price at the time that we go under contract on the home. And maybe most importantly, our clients have skin in the game. This is not a free option. They're putting down an upfront payment that's going towards their down payment and closing costs, which is could be anywhere from 3% to 5 to 10%. This is not a fee. This is money that they're getting back when they buy, but it is money that they forfeit if they default. So this puts us in a unique position versus any other landlord in that we have a deposit that represents 4, 5, 6 months of rent. And so even if somebody is falling behind a month or two on their rent, they have an incentive to catch up, or they have an incentive to work with us on a move-out plan, which is far different than somebody who's in an apartment or a house. They've got they stop talking to the landlord, then they just move out one day or wait to be evicted. And frankly, that 1 month security deposit doesn't do much for the landlord at that point. We've got a much bigger piece from our clients here in those situations. So thankfully, it hasn't happened a lot, but it really kind of focuses their motivation to follow through. We have very low leasing and vacancy costs versus a traditional landlord. So a traditional landlord is going to acquire an asset. They're going to spend some money on rehabbing it, cleaning it up, whatever. Then they're going to spend money on leasing. They pay leasing commissions out. All the while that this is going on, they have carrying costs, their vacancy costs while the property is sitting there. In contrast, with Dream America, we buy a house today that our clients picked. We begin collecting rent immediately. There is no rehab costs, there are no leasing costs. and there's no vacancy costs. And at the end of the term, they buy the home. We don't have any brokerage commission because it's a direct sale to the tenant. And again, we've had no vacancy, leasing, or rehab costs from that client. So that gives us a real operational advantage versus just a standard landlord that's frankly would be difficult to recreate outside of our program. Our program is structured to incentivize purchase in the first year. As I mentioned, our rent is higher than a mortgage payment, so they're already living in the home that they want to buy, and they know that as soon as they do buy, their monthly payment is going to be reduced. No reason for them to drag that out any longer than they need to. We also have a preset markup that we're using for the sale back to the tenant. I'm going to show you those numbers in a second. But basically, it's increasing over time value of money. The longer somebody rents from us, the more we're going to charge them when they buy the home back. And the last point here, I think, is true of rentals in general. It's a defensive asset class. So yes, a lot of people are under stress now, but the most painful thing is an eviction, meaning if I don't pay my credit card on time, yes, that hurts my credit score, but the consequence to me day to day is very run out of my house. That's for any landlord, but in the environment that we're in, when we look at rental properties versus other asset classes, I think it's worth pointing this out. So what are these components of return that we're talking about here? Rent, we talked about that. We're collecting this premium rent each month. We've got our 1% upfront fee, and then we have a potential gain on sale here back to the tenant. So we charge a standard markup, which is 6% for 6 months and 10% for a year. And that's partially offset by what we call the on-time rent bonus, meaning as long as our tenants are paying their rent on time, we're going to contribute 10% of those payments toward their closing costs. So it's going to help them with their purchase, makes a nominal difference in our returns, which just gives them another incentive again to follow through on the program. And you might look at that and go, wow, 6%, 10%, those seem like easy numbers the past year where prices went up so much, but how do you ever pull that off when home prices are not appreciating rapidly? And for example, in the market that we're in right now, the key is not just where we're going to sell the home back, it's what we pay today. As a cash buyer, once again in today's market, as was the case in 2018 and 2019, all the pre-pandemic periods, we're able to extract a discount versus the buyer who's coming in with a mortgage contingency because we bring certainty to the seller. That is not extra money that we're putting into our pocket or our investor's pocket. It's money that's ultimately going through to our tenant in the sense that the less we pay today, the less they pay in the future. So put a concrete example on that. If we buy a home today that's for 5% less than its appraised value, and we're going to sell that back to the tenant in 6 months, we don't need the home to appreciate 6% in the next 6 months. We need it to appreciate 1%. And we're going to talk a little bit more about the appreciation in a minute and why we can get great returns even without it. So here is an actual example. We use a static pricing model for rent. It's posted on our website. We strive to be 100% transparent with our clients. All the elements, go to dreamamerica.com. All of the elements that a client is going to face in the program are posted there. We never want somebody going into a home and then saying later, boy, I really didn't understand how this thing was going to work. And so you can go on there, you put in a home price, you pick which state you're in, and you will see the rent. And if there's any HOA, you add that on there. We're charging the same rent in all neighborhoods in Texas. Otherwise, a 250 house, we're charging the same rent everywhere. So this is a Georgia example here. 250 home price. Again, you can go to the website, put in 250, and you'll see this 2380. Got property tax of about $3,000 a year, our insurance costs, the fee that we charge up front, that 10% markup for 1 year, so 250 turns into 275 a year out. And we're collecting some upfront cash from the tenant, which is not part of the economics, but the absolute minimum is $5,000. In fact, on a 250 home, we'd be collecting at least $10,000 from somebody up front. Then over the course of a year, what does that look like for the investor? You've collected a year of rent, net of property tax and insurance. You have this potential gain on sale when they buy the home back. You have the onboarding fee, less that on-time rent bonus. So gross economics is about $45,000 on a 250 house with a 1-year hold fee. Less the management fee and profit split, we charge 1 in 15 within the fund. That's going to get you to a cash on cash return in excess of 14%. And now some people will look at our strategy and say, well, oh boy, well, what if they don't buy? Then what happens? Well, if you just run through these numbers here, take that 24,210 divided by your 250 purchase, you can see that we're getting a very high yield just from the rent. The rent is the cornerstone of the return. The best possible outcome for our investor is also the best possible outcome for the tenant, which is that they successfully complete the program and purchase the home. So we have a perfect alignment. It's not like we're better off if they fail. We would never want a program like that. But if all that I'm pointing out here is if they're unable to complete that purchase, this is not a disaster. We can then take that property, put another client into it. We could resell it. We could turn it into a traditional rental. There are a lot of different uses for these home prices. And you can probably realize looking at a 250 price, these are starter price homes that we're focused on. These are not high-end homes. And that's an important element for us. We say that we're focused on homes that are 150 to 400. Most of our clients, it's 250 to 350. We like this price point because there's a shortage of these homes. And yes, in today's mortgage prices are higher and home prices are higher. Homes are less affordable, but it's also more expensive to build those homes. So the supply of those homes is not going to dramatically increase over the next few years. It may not increase at all. It may decrease if something happens to some of them. And so the demand side for those may be lower right now, again, because the mortgage rates are higher. And another piece that we didn't talk about yet, which is the big rental companies that were running around in our markets in Q1 and Q2 trying to hoover up every home and turn it into a rental. They've had to pump the brakes due to the securitization market, more or less freezing up for rental financing. So those big cash buyers, yes, they have a lot of cash, but a lot of that cash comes from the securitization market, and that market is in a bit of disarray right now. And so we just don't see those buyers right now. But are they gone forever? The guys that own 10, 20, 50,000 homes, they're not gone. They're going to come back. As soon as we see that the Fed is no longer raising interest rates, the market will quickly start to discount them. Once the increases stop, that means the decreases are in the future, and the market, as we all know, will discount that information quickly. Securitization market will go back to work. All of these buyers will come back. Is that going to be next year or the year after? I don't know. What I do know is between now and then, there's not going to be a bunch more of these homes. So these people that are sitting on the sideline, they're all going to run back into the market, in addition to the individuals who actually want to live in these homes, and the demand will go back up. It's a long way of saying, despite the headlines, I think now is actually an excellent time to try to buy one of these houses, because if you're coming in, you've got a lot of negotiating leverage with the seller. Properties are sitting out there. They're does. And that just hasn't been the case, earlier this year and last year, where you saw all these stories of, home goes on the market and it's got 10 offers the first day. And, most of them are cash offers. That was that market was actually not a great market for us. And it wasn't a great market for anyone who's trying to buy a house. The big investors were muscling out the individual homeowners in that market. And now, once again, the individuals who are getting mortgages do have a shot at getting a home. So like I said, I think this is a great time to get out there and look at these homes. Coming back to our fund and what have we done here. Since inception, we've purchased 191 homes, just over $50 million. We've sold 73 of those homes, and our average holding period on the sales was just over a year. The average annualized net return on those sales, this is to the investor, was 26%. And no surprise when you look back at, this number, and well, this is an unlevered number, and we do use a little bit of leverage in the fund. We've got a revolving line of credit, use some rental financing in our business, and so our LTV on average has probably been around 50%. So it's not a highly leveraged strategy, but we've been able to generate good returns. And 75% of our sales have been to our tenants. So the program works. And those other 25%, those aren't all people that failed. We've had a few people fail, but people have change in family circumstances. They get divorced, they get remarried, they get a job in another state. So there's all sorts of reasons why people ultimately may not follow through and purchase the home. But the fact that we have had such a high follow through rate, I think, kind of speaks to the the success of the program. And as I said before, our best outcome is for the investors, so that we don't have those turnover costs, is to have the tenant buy the home. So we want to continue that. And then, what do the distributions look like to the fund investor? This is the, I would call it the composite average across the fund. So when we started out, we said we want to target sort of 10 to 12% annual distributions. We've been able to do that the past few years. The actual distribution that the investor will get is going to be a function of what homes we've acquired since they joined the fund and how long we own the previous homes. So what does that mean? Rather than have a complicated regime for NAV in the fund, if you invest you're investing in our we've acquired that are worth substantially more today. So how is that fair to the existing investor? Well, what we do is when we sell one of those legacy homes, the profits are divided based upon your time-weighted pro rata share of gain. So if you invested next month and we sold a home that we'd already held for 23 months, we're 2 years into this house, you're going to get 1/24 of your pro rata gain on sale of that legacy home. So the investors, for example, who came into our fund in 2020, their annualized distribution this year has been 16.5% because they've gotten a bigger chunk of gain of those homes that we sold in 2020. Whereas the folks who came in this year, they're getting 100% of the rents and fees that we're collecting now. They're getting 100% of their gain on sale on new homes that we're acquiring now, but they're getting a smaller slice of those legacy homes. So that's how we've handled that. And the last thing I want to mention here before any questions is a number of people have asked me, okay, well, we all know rates are up, home prices are less affordable. So does that mean everybody who's in Dream America right now, are they stuck? And the answer is no. When we were underwrite people into our program and we just set their budgets, we always assumed that rates were going to be higher. We never gave our clients the benefit of a 3% rate because we knew they were never going to get that for a variety of reasons. Did we predict that rates would be where they are now? No, but we built in a buffer so that when we look at a client's potential debt to income ratio, which is a critical underwriting metric when they're getting their FHA or VA mortgage on the back end, we left room in there for higher rates or higher payments that they didn't have today. Even though we make all of our clients sign a pledge saying that they're not going to apply for new credit, they do go out and apply for new credit. And so we're building a cushion in. So here's an actual example of a property that we bought in Jacksonville in September of 21 for $235,000. At that point, had you been able to get a mortgage and buy that home, your monthly payment would have only been $1,457 a month. But the rent that we set for our client was much higher than that. Now, however, this is where the affordability piece comes in. That's home's worth $290. If I was buying it, I'd buy it for less, but that's what Zillow says it's worth. And so your payment with a 7% mortgage would be $2,485 versus $2,800 rent we would charge on that. And if you say mortgage rates are even higher, well, what if they go to 8%? Point of this chart is that even with an 8% mortgage, the tenant in this home could still qualify for the mortgage based upon their debt to income ratio. So the point is that higher rates have not, trapped our existing clients or blocked them from buying. Now, these folks haven't bought yet because there's other things that they're working on within their credit profile. But the good news is that when they do get to that point, and hopefully soon we help them complete it, even at today's higher rates, our tenants can still follow through and buy the homes that they're in. So hopefully that gives you a little bit better sense of what Dream America is up to and some of the points of differentiation versus a standard rental and why we think we can continue to do well in the market environment that we're in now. And we're actually excited with the clients that we're working with out home shopping, because we're finding that they have choices once again. They don't have to jump on the first listing that they see. We can actually go and look at the house. We can negotiate with the seller so that if there are items that need to be repaired, we can get a credit from the seller and deal with those things up front. And ultimately, if we cannot negotiate a good deal with that seller, cancel that contract, get their deposit back. With that, and I've got a few minutes left here. I'm happy to take questions.
Chris, can you hear me now?
Yeah.
Okay, great. So, which markets are you most active in?
Yeah, that's a great question. Our key market is Atlanta Metro. Atlanta Metro is a popular market with large institutional rental investors, Invitation Homes and others, which is why we were actively bumping into this crowd when they were active earlier this year. They'll be back. It is also the number one quote unquote rent to own market in the US. Why do I say that? What I haven't mentioned is the largest player in this field is Home Partners. It's a group that Blackstone bought last year. They have 17,000 homes that they're offering out rent to own. And they made an announcement it was a couple of years ago that Atlanta was their number one market. So if they're the biggest player, they have over 2,000 rent to own homes there. We know that it is uh, Tampa and Jacksonville and Orlando. We are based in Miami, but we have not operated in Miami because the price points are just too high for our client base. We really want to, in thinking about, you could run this strategy in any market, but for us, we want to operate in a market where if you're making a median income, you can afford a that gives some underlying standpoint and affordability. And it declined a little bit, but it's still true in the market that we operate in. That's just not true in Miami, unfortunately. If you earn a median income, you will not be able to buy a house.
Prices have gone up. Bill has a question. What can go wrong in the changing environment?
Oh, lots of things can go wrong. The biggest risk that I see is not around the home prices. So there's a lot of doom and gloom now about home prices. Everybody, large investors and banks go in the same direction. I know because I worked in banking for 25 years. So at the beginning of the year, everybody loved houses. Let's buy every house we can get our hands on. The banks are lending money hand over fist, securitization market at cheap terms. Now all of a sudden it's like, whoa, we're worried that home prices are going to go down, and they are going down. We're seeing that. I just feel a lot more confident about the price point homes that we're at, that there's not a lot of downside because you can't replace them and people have to live somewhere. And what happens to when, due to rising rates, I'm that 400,000 home buyer, 500,000 home buyer, and I can't afford it anymore. Now I'm in a 250 home, or maybe I'm back in multifamily. Again, people have to live somewhere. So I'm not super worried that those home prices are going to crash. Where what we're seeing, which we saw in the slides here from the Fed, is our clients. Our client is the average American. They're getting squeezed in this environment by food costs and utility costs and other things. We see more people who can't pay their rent on the first. Now we stay on top of them, and they pay it weekly. Maybe they pay it two weeks late. But a couple of years ago, that really just wasn't a factor. Everybody paid on the first, so people's budgets are really tight. And so where we have risk is where a lot of landlords would have a risk is that all of a sudden your tenants are unemployed and they can't pay. There's a big recession and people don't have money. They can't pay the rent. Yes, we have more dials to turn, but if you don't have a job and you don't have income, the fact that I have a larger deposit isn't going to make you pay the rent. Now, it may make you amenable to working with me to move out so that you can get part of your deposit back so we can skip a big downturn. Yep. With our clients, finances, a landlord get a pay stub and they do a background check. Is the number two payment after housing. We know what everybody's car payment is because we're doing an underwriting on the front end that is akin to what a lender is going to do. Because again, we don't want to take you if we don't think we can help you get a mortgage. And the only way we can come to an educated opinion on that is after you fill out that application on our website, you get an automated pre-approval, but then we have to get your pay stub and your bank statement and your tax returns to make sure that we can validate all that information just as a lender will do so that we can be confident that we're putting you into a property that you can afford. And so that I think, is good for us, but it's not going to, if the belief is that job loss, then we're going to be probably should go that it's not a terrible idea. I just think that the headline sentiment around housing was overly rosy at the beginning of the year. Now it's overly gloomy. But the fundamental story that you're going to hear anybody talk about is talking about housing in terms of there being a shortage of supply. That hasn't changed. It's not going to change. If anything, it gets worse when financing gets more expensive because home builders stop building homes. So they can't sell them. So they're just sitting on their land, but they're not going to crank out houses and sit on empty houses. So how is the supply better?
So, Chris, our next speaker is up. So I want to thank you for coming on today, and it was an excellent presentation. I will be following up with a copy of the presentation as well
Thanks,
as a
Michael.
link to your marketplace listing. Thank you for coming on. We look forward to your progress